2023 was a pretty amazing year for the stock market, especially for tech and growth stocks, with the tech sector rallying over 50%. But I think in 2024, that growth will continue upward, especially if we see rate cuts that the Fed has been in talks of. So today let's talk about 3 different tech and growth ETFs that are set to continue climbing high in 2024. Now keep in mind too that tech and growth ETFs tend to be a lot more volatile, meaning they experience a lot more aggressive ups and downs in the short term, but in the long term they almost always come out on top and beat the S&P 500 by pretty big margins. With that being said, let's jump right into the first one, which is an ETF that mostly tracks companies in the technology sector. It's called IYW, or the iShares Technology ETF. Like I mentioned earlier, tech stocks have had some nice upward movement in 2023, driving the returns for IYW up to around 65% last year. IYW is an ETF that, according to its prospectus, seeks to track the investment results of an index composed of US equities in the technology sector. So very similar to comparable ETFs like XLK and VGT, but we'll talk more about those a little later. Something I really like about IYW is that it's slightly more diverse compared to typical tech sector ETFs, since it includes communications and advertising stocks like Google and Meta that you won't find in other tech sector ETFs. Looking inside its portfolio, Apple and Microsoft have similar weighting at around 16 and 17%, with Google taking up another 10% of the portfolio if you include both ticker symbols, with Nvidia at 5.2%, and Meta right at 4%. The current price for IYW is at $128, right at the top of its 52-week range, with tech stocks being at their all-time highs, and a pretty standard expense ratio at 0.4%, so not too high but not extremely low either. So IYW has been one of the top performing tech and growth ETFs that completely outpaced the returns of its counterparts, XLK and VGT, and it's one that I think will continue to rally throughout 2024. This next one has also been on fire lately with the AI wave that we saw last year. It's SMH, or the Van Eck Semiconductor ETF. So semiconductors are not only the brains of basically any electronic device around, but they've played a huge role in the AI movement as well, which was a huge success, as we know, in 2023. Its total return last year was over 71%, and just might produce similar returns this year in 2024. Although a lot of these semiconductor companies can be hard to fully understand, they're some of my favorites to invest in because a lot of them are simply just growth and compounding machines, and we've definitely seen this as of recently. With that being said, let's look at the top 10 holdings in SMH. So one of the reasons for all this intense growth within the last few years has a lot to do with its top holding being Nvidia at 22%, which can be considered a lot of weight towards one stock, especially since this specific sector can be considered more high risk, yet high reward. Then we have Taiwan Semiconductor Manufacturing at 9.5%, and other similar companies like AMD, Broadcom, and Lam Research in the top 10 holdings. And keep in mind too that this ETF has a very low amount of holdings. It only has about 26, and the top 10 make up just about 70% of the portfolio. But with that lack of diversification comes with a lot more explosive gains when we experience a healthy bull market. With the exception of 2022, the last 5 years have been great for the semiconductor sector, giving SMH a total 5-year return of 321%, completely crushing the returns of basically any other sector ETF. Its current share price right now is $187, also right at its 52-week high, with an expense ratio slightly lower than that of IYW at 0.35%. It also pays a fairly small dividend of 0.56%, which helps to offset that cost of the annual management fee. So holding SMH in your portfolio can supercharge the growth and provide you with double-digit returns if you're willing to take on a little more risk. Number 3 is another tech-heavy ETF. It's QQQM, not to be confused with the classic QQQ. Now this ETF is of course very similar to QQQ. It's owned and managed by Invesco, the same firm, but there are slight differences between the two that, in my opinion, make QQQM a little more superior. So this is a NASDAQ 100 ETF that tracks the returns of that index. So it's perfect if you're someone who's bullish on stocks like the Magnificent Seven and like to hold some of those pretty fast growing large cap companies. It also had a very nice return last year of 55% as tech stocks recovered from the previous year's bear market. Okay, so at this point you're probably wondering what the differences are between QQQM and QQQ. And the only two major differences are a lower expense ratio at 0.15% and a slightly higher dividend yield at 0.65%, and this is of course for QQQM. So these differences are very marginal, but still beneficial, especially if you're holding for the long term. So now that we've briefly covered these three tech and growth ETFs, let's now take a minute to compare their total returns. If we pull up the 3-year time frame, we can see that the returns are all very similar, especially for IYW and SMH, both at over 50%, with QQQM trailing behind at about 33%. And as we know, past performance doesn't always equal guaranteed future returns, but these ETFs tend to grow extremely fast when we're in more of an optimistic market. But let me know in the comments below what you guys think of these 3 ETFs and if you already own them or would consider adding them to your portfolio or not. And I'll see you next time.